Ryan, and everybody for joining us. I'm going to share the screen, and hopefully you can see that now. And we have a bit of ground to cover. It's an ambitious agenda, which where we'll focus on anti-bubbles and the macro picture. Just to elaborate slightly on my background, I'm an engineer, mining and petroleum, master's in mineral economics. Spent the first half of my career with some of the investment banks, JP Morgan, Goldman Sachs, Merrill Lynch, between London, New York, and Singapore, before I moved on to the buy side with my own firm and some large players like Bluecrest or Diamond, before I moved back to Spain to be managing partner at Quadriga. But I'm also a best-selling author, which is why a number of you know me. This is part of my team, which is very strong with a lot of experience. And yeah, as a book author, I've written two books. One with my good friend Daniel Lacalle. It's a book published in 2014 called "The Energy World is Flat." It was a very contrarian thesis at the time, with oil around 120, and we're putting forward this contrarian framework, which of a flattening of the energy world, which has not only survived but actually strengthened. And I did learn a tremendous amount through that process of writing. I encourage everybody to write anything. If you want to learn, teach. Cicero would say. I would say if you want to learn, write. And I kept that discipline of writing, which led to my second book called the Anti-Bubble or Anti-Bubble. And a number of selected contributions, such as this article in the front page of the Sept. Some of you are familiar with it, a number of you are not, and I'd like to take the opportunity to review the concept and also update and fast forward into the future, what might be ahead of us. And I'd like to start perhaps with the definition of bubble. And George Soros defines bubbles as assets that are artificially expensive, based on a belief that happens to be false, what he calls a misconception. So what I did is I tried to generalize the framework and looked at basically bubbles. You look at misconceptions can distort reality, but they not only distort reality through artificially high valuations, you could also have artificially low or artificially cheap valuations. So in that sense, the first dimension of the concept is assets that are grossly artificially cheap, based on a misconception. There's some sort of extreme value. The second dimension of the concept is this idea that bubbles and anti-bubbles are like distorted mirror images of the same process. So by construction, the moment the misconceptions understood and the bubble bursts is the exact same instant that the anti-bubble will reflate. So in that sense, I like to think of anti-bubbles as a good hedge or protection against the bubbles. And there's a third element, which is the sort of risk premia angle. There's being contrarian, and basically one way to think about this is one of my favorite examples is the relationship between volatility and risk. Look at this graph. We're seeing at the top the S&P, at the bottom you look the VIX. And what you see is that during periods when volatility might be artificially low, this complacency in the market might give to perhaps artificially high equity valuations, and things tend to reverse. With volatility going up, asset values collapse, and then again you might be in a situation where perhaps the most interesting thing is that insurance tends to be cheapest when you need it the most. So you tend to need insurance when equity markets are high, when the moves already happened and volatility is already exploded. By then, perhaps you don't need it that much. So this idea of being contrarian, of anti-bubbles being assets that are perhaps artificially cheap, a great hedge, and that could provide some risk premium, is something that we elaborate on. But really the key thing is this concept of artificial and misconceptions. So where are we now? What's the situation? What are the current beliefs and misconceptions, and how are they distorting reality, and what might be the bubbles and the anti-bubbles? And the key start, and the key of the problem, in my view, the starting point is monetary policy without limits. This idea that we can actually solve problems by just printing money. And this process is been ongoing. It's been ongoing pretty much. It's part of the system. It's part of the construction. And we've seen over the last years and decades a transition that has accelerated into bringing interest rates to zero, printing large, if not infinite amount of money, even leading us to negative nominal interest rates, which was considered to be an impossible or some sort of aberration in the textbooks. How central banks have continued that buying from government bonds into other forms such as credit or even equities, as we've seen in Japan and other markets. How we've seen this flood of liquidity, this helicopter money being used to effectively give just money to people, and how effectively this money printing is not only used for domestic purposes, but also as a weapon in part of these currency and trade wars, which are sort of mirror images of each other. You could have a situation where a country is devaluing their currency in a competitive basis to try to beggar thy neighbor the problem, pass it to the neighbor. And then the other country tries to defend itself first by also doing a lot of monetary, as you see the global dynamic, but also through tariffs and other forms. So at the end of the day, if you devalue by 20% and there's nothing I can do, I might tariff you by 20%, and that will neutralize the effect. So all these dynamics are very interlinked, but the key message I want to give is that by printing money, we are not solving problems. We're doing basically four things. The first thing we're doing is we're delaying the problem. We're kicking the can down the road. We are giving it to the next generation. We're creating debt. We are passing the problem. We're not fixing it. The second thing we're doing by printing money is we're transferring the problem through currency wars. As I mentioned, you're passing it from one country to another, creating big issues. We saw Europe blowing up in 2012, partially because of the action reaction with the monetary policy by the Fed following 2008. So this transformation, this transfer of the problem also leads to the third dimension, which is the transformation of the problem. And basically, you are creating inflation. You might be creating bubbles. You're certainly creating inequality through this process. And this artificial nature eventually, unfortunately, enlarges the problem. It doesn't fix it. So we've seen this movie before, as my good friend Daniel Lacalle would say, if money printing and debt were actually useful, then Argentina or Venezuela would be world powers, and they're not. And I think what we're seeing in some way is this dynamic accelerating, but there's a belief in the market that it works and that things are being solved when in reality, perhaps they're not. This is a bit of a house of cards. So I'm going to give some detail into and explain and put things in perspective to see what it means. And what you see here in blue is the US Fed funds, is short-term interest rates since 1998. Some of you were maybe not born. And in white, you see the central bank balance sheet, and we see the relationship between them. And once upon a time, we had interest rates at 6.5%. We have this big dot-com bubble, which I think might be repeating itself now in some ways. And what is interesting is the response to that bubble brought this dramatic drop in interest rates, which got all the way to about 1%. The recovery, there were China and many other things that were happening at the time actually was quite swift, but we never quite got to the previous level. We got to about 5.5%, things steadied there, and then we all know what happened in 2008. We had this major crisis, interest rates were brought to zero, and for the first time in a long time, we had this major, considered to be at the time, major increase in balance sheet by money printing, which was thought to be highly inflationary and considered to be short-term, but we know where we are. Many of these short-term temporary measures are actually becoming permanent. And so we saw QE1, we saw QE2, we saw QE3, named or dubbed Q infinity, because monetary policy is subject to the law of diminishing returns. There's more and more asymptotic. You need to do bigger and bigger volumes to achieve lower and lower results. But nevertheless, after a long period of keeping rates at zero and printing money at a very fast rate, we got to the point where we eventually tapered and started, as you can see later in time, increasing interest rates and started a process of quantitative tightening. Now, eventually, this got us to about 2.5%. Okay, I remember many great analysts calling for, even Jerome Powell calling for autopilot for normalization. Guess what? When you've increased your debt by multiples, your ability to pay back debt diminishes as interest rates go up. So ceteris paribus, I might afford, a loan at 5% in $100. If my loan is now 200 or 300, I will blow up if interest rates go about 2.5 or whatever. And that's effectively what happened. We saw in Q4 2018 things blowing up, and we saw basically even prior to COVID, we had already, I think the damage was already done, and we were already at 1.5%. And obviously COVID brought things to a whole new dimension. We saw rates to zero, and what has been an exponential growth in money printing and bringing us into a whole new world of MMT, you call it whatever you want, modern monetary theory or magic money tree or whatever you like, but certainly a new dynamic, this paradigm where we can print and solve problems, you can borrow and spend as much as you want without any consequences, which unfortunately is not the case. The impact is not just in the short end. You have, which is in blue, we see what's been happening to long-term interest rates, and this term premium has been dramatically diminishing, going down. That ceiling, which in some way acts as some sort of prediction of where long-term rates will find the equilibrium, it's been following lower and lower and lower, and not actually meeting its expectations and targets. And then what we're seeing now is the market is in some ways starting to see some inflationary pressures, trying to predict hikes in rates, but this is something that is, in my opinion, very difficult to occur given the large debt we have. And so where is that ceiling? The market right now is probably closer to 175, but the Federal Reserve has these expectations, these dots, and where do they think things are going to be? We see here, this is the last one. We see that for the balance of the year, they expect no change, but then within 22, 23, the board members start to be a little bit more diverse in terms of their opinion. And then in the long term, they're sort of looking at things as potentially going up. And these long-term expectations have been dramatically adjusted lower over time. So it's sort of this realization that they can't go up, and they're slowly doing this. And right now, the Fed has this perspective that they think they can actually bring things up to about 2.5%. The market doesn't agree with them. It's much lower than that. And I suspect this trend will continue as we've seen in other parts of the world. So this monetary policy without limits continues. And the reason we have it is largely because of another major problem, which is this idea of fiscal policies without limits. Is the idea of I can not only print my way out of a problem, I can borrow my way out of a problem. And this takes multiple forms. I'm originally from Spain. I love my country, yet it's hard to argue that our fundamentals support borrowing at negative interest rates. No matter how you look at it, it's obviously not a real number. It's 100% artificial, and is a result of money printing and money being lent to these governments ad infinitum. So in that sense, the entire process, the printing and borrowing go hand in hand, and it makes it very, very difficult for things to normalize. Once upon a time, Larry Summers called this massive expansion as the prudent imprudence, right? And how the rules of the game have changed. And we've seen all forms of fiscal aspects, whether it's spending or debt, which has gone into a whole new level with MMT and bailouts and checks and stuff. So this process where I can do this by just financing it by money printing and nothing happens and there's no inflation, they're beliefs that are widely accepted on the market. I believe they're misconceptions. They are not correct. So the thing that so my view, even going into COVID, was damage was already done. Those of you who've read my book, The Anti-Bubbles, I talked about this process. I summarized the last decade in one sentence. It's the transformation from risk-free interest to interest-free risk. And this is really what happened. You ended up, you transitioned from a world, as we'll discuss shortly, where once upon a time, you could actually park your money in treasuries or bonds and earn a nice return above inflation, to a world where now there's really nowhere to hide. It's financial bullying. And I think this dynamic, which has accelerated with COVID, which has been a massive paradigm shift, I think the next decade, if I have to summarize in one sentence, is we're creating these bubbles that are too big to fail, and that will eventually lead to stagflation, with or without a blow up in the middle or more. But certainly not a very benign environment. And I think the price will pay for this monetary and fiscal abuse. These are some considerations, some concepts. This slide hasn't changed at all ever since the beginning. I was looking for disconnection of the markets and many things that have in many ways materialized, not all of them, but certainly a world that is highly distorted. Now, I'm going to talk a lot about inflation, and one of the key things here, bringing back the slide on interest rates, is the concept of nominal interest rates versus real interest rates. And basically, when you get compensation for your money in the form of nominal interest rates, might be 5% or 2% or whatever, that looks great. But at the end of the day, that compensation may not be enough if the value of your money is being eroded by 5 or 10 or 50% a year, right? So in that sense, the difference between this is the inflation break-even. And we see that for a long period of time, we lived in a world of positive interest rates with inflation relatively stable and capped around 2%. The game is changed, and it changed notably into the European crisis. But as I explained my teenager kids, if investing was a video game, it would have 3 levels. The first one is, can you make money in nominal terms? Now you look at this graph and it still shows, I can actually make money. I can turn my $100 into more than that, or my euros with a 25-year bond at 1%. Now, the reality is, if you go to level 2, which is, can you make money in real terms? There's trillions and trillions of dollars that are already losing and that have a very asymmetric risk reward. And the third level will be, can you make money after inflation and after taxes? And this is the third dimension that is coming, yes or yes, as Mark Twain would say. And so we've seen this entire process where throughout the years we moved into negative interest rates, had a period of, where it looked like we got our head above the water, but really COVID and deflation, we've seen a whole new paradigm now with effectively the Federal Reserve breaking loose of the 2% ceiling and basically letting inflation go, which, as we'll discuss shortly, the official inflation is completely not realistic, but nevertheless, they can't even control that thing. Real inflation is way higher, and this is one of the degrees of freedom of all the abuse that is taking place. So where are nominal rates going to go up if inflation comes? Many people think they have to go up because that's what the textbook says. As I will repeat over and over, we cannot hike interest rates. I know that if inflation comes, we should, but the answer is we cannot, because we've created these massive bubbles that would implode and would lead to other problems. So in that sense, I think nominal rates are likely to stay low and potentially lower to try to prevent these bubbles from imploding, and real interest rates are likely to be very deeply negative, which is obviously a very bad scenario for a number of things, including cash or fixed income or credit. So with that, let's fast forward a little bit into what's ahead and the consequences of where we are. And I'd like to start with this idea that this monetary and fiscal abuse, this transformation, has actually created bubbles that are effectively too big to fail. And it has, this distortion has multiple dimensions that are hugely important. The first one is there's no such thing as risk-free interest anymore, okay? You cannot, the bank, the treasuries, etc. We're talking about stuff that is paying zero or negative, especially in real terms. So there's nowhere to hide, and this leads people to be bullied into taking risk, which is what they want. The second important dimension is that the conventional 60-40 portfolio, this idea that you had equities and fixed income, Once upon a time, when the treasury or the bond paid you 5% yield, it meant that if there was a crisis and your equities collapsed, the fixed income would go up because you have plenty of room. I mean, think about it. A 10-year bond at 5%, if yields go to zero, the present value of that 5% over 10 years is almost 50%. So, you know, your 10-year treasury could earn 50% gain, which would largely offset the losses in the equity. And that was with just interest rates at 5%. Obviously, a 30-year bond will have many more cash flows to discount. It could be 150% of gain. So the idea, once you go to interest rates at zero and potentially go into negative, your ability to defend diminishes. And therefore, the portfolio has a problem because your equities are highly artificially valued and your defender can no longer defend. And this is why I call the Bund, Franz the Bund Beckenbauer. It was this very famous German player, football player, who was an amazing defender 30 years ago. Today is like 75 years old. So not in the same position as he was before. So very important implications for portfolio construction and how you balance risk in the portfolio. The third thing that is critical to understand is that when you bring interest rates artificially low, let's say to zero, then what you're doing is you look at, if you think about value in assets using discounted cash flows, we're basically discounting things at zero. So you're indifferent between $100 today or $100 in 50 years, right? This is dramatically different from a world with normal interest rates of 5%. You would rather, you know, the equivalent between receiving 9 cents today or $100 in 50 years, that would be the parity with interest rates of 5%. At zero, you've discounted all these cash flows at huge values, which is why equities are so high, especially when you look at the growth element. So there's a big element, as we'll discuss shortly, in the duration of equities, which is not well enough understood. And that is part of the reason why these bubbles have been created and the risk is being compounded. So I think it's been, for a while, we're already into systemic territory. These bubbles, this house of cards, which is built on artificial low interest rates, are by now too big to fail. There is, the central banks know this. They had a big scare in 2018 where GE and a bunch of others were on the brink of collapse. Miraculously, they got everything going. And since then, they've been very preemptive about, you know, preventing these things from going. And the central bank put, in some ways, has merged into a central bank call. But let's not fool ourselves. This is 100% artificial, and we're not solving the problems. So as we discussed earlier. And I think this is a scenario where I keep going back to this. Yes, we might be creating inflation, but central banks cannot hike interest rates. I think it's going to be extremely difficult and painful to do that. And if they try, they will see themselves being forced to cut again as people blow up. And so it's a dangerous game. This idea that mommy and daddy have my back, it's also leading to a lot of leverage. There's a lot of hidden leverage in the system, and this sort of feeds into the loop. So going back into this idea of equity duration, you know, I encourage, if anybody's interested, to read a piece from my colleague Alfonso Torres in LinkedIn. It's called No Premia and Equity Risk Premia. And basically, if you try to compare equities and fixed income, you know, it's apples and pears. People use this model where we say, okay, let's look at the equity premia, trying to basically make the equity look like fixed income. And throughout this comparison, people would say, yeah, I know equities are super expensive in absolute, or high rather, not expensive. But however, look at them relative to fixed income. They're so cheap, right? So the artificial price in fixed income is obviously translating into artificial price in equities. But what it's not so clear to many people is the duration, the effect that long-term interest rates have on equities. And we estimate that the S&P has about 28 years. So when you actually try to compare equities to fixed income, many people make the basic mistake of comparing the S&P to the 10-year treasury because it's convenient, but that's really not apples with apples. So you should be comparing with long-dated yields. And our conclusion is that equities are expensive both in absolute and relative terms. Having said that, bubbles can go for a long way and much longer than anybody expects. They also tend to go much lower, much faster than anybody expects. So a word of caution on that side. With that, going back to inflation, this idea that I can actually inflate my way out of the problem. This is certainly the plan for central banks and governments, the left pocket and the right pocket. This idea that they can actually create a lot of debt, and someone will pay the party. We'll talk about who. But the inflation deflation debate is fascinating. There are lots of deflationary forces in the system. Call it technology, demographics, overcapacity, malinvestment, bubbles, unemployment, whatever. But there's sort of, obviously we have bottlenecks and others, but there's this one little force called money printing, which actually can offset them all and more. And so it's almost like the more deflation there's in the system, the more I can print without creating the perception of inflation, but it is de facto, and it's distorting things. And the important thing here is that inflation, I always say, is not about the value of your house going up. It's about the value of the money with which you buy your house going down. And this is a very different story, and it's something that is accelerating, and that I think has the potential to be a big problem on a global scale. Now, eventually, stagflation, the economist's nightmare, is this scenario where everybody's unemployed, yet prices are going up. And people are scratching their heads saying, how can house prices go up if we look at the economic activity? Well, it's not house prices going up, it's the value of that money going down, and everything's going up. So this dynamic is, again, be careful what you wish for. Central banks have been calling for the enemy is deflation. We need more inflation. Let's break the ceiling. Let's print. Let's find all sorts of, let's change the goalpost, whatever you want to create this perception. But you don't need to be a genius. You just need to go to a supermarket or look at the house price or whatever to know that your purchase power has been diminished. So in that sense, I happen to be a very big advocate of gold. I've been an advocate for a while, and my thesis has been reinforced. It has been a tough past 12 months for many people who think like me, but I do believe that gold has a meaningful role to play for lots of reasons, and which have been very well argued by many people. There is a new entrant here, the crypto space. If you're interested on my views, a detailed analysis, please read a piece I wrote on LinkedIn called Bitcoin Bubble or Anti-Bubble. You may not like the conclusion, where I believe that it's 80% bubble, 20% anti-bubble, but I try to be as unbiased as possible. And I do a lot of, as I did in the energy book, I challenge many of the beliefs, which I happen to, in my view, misconception. And I just highlight one, which is the scarcity fallacy, right? This idea that there's only 21 million Bitcoins, which is true, but you can create 21 million other cryptos out of the blue. And so the concept of scarcity in the crypto space is kind of ironic how it's been used. But look, there's super smart people that I respect a lot that are great believers. Do your own research. I am concerned, and I think this is again much more of a bubble where whatever the NFTs are, to me, the second derivative. It feels a little bit like in 2008 when we had the CDOs and then the CDO squares and everything. It was sort of compounding on this alchemy of money out of nowhere, and that's in a way what's happening with many of these cryptos, which are literally money out of nowhere. Is simple wealth effect. Easy comes, easy goes. So we'll see how the movie ends. Well done to those that are making a fortune, and just be prudent and mind the leverage. The one key anti-bubble, however, that I want to discuss in detail is volatility, and I talked about it earlier, and I basically use the analogy of fluid mechanics. Where nature has these two regimes: the laminar regime when things are linear, normal, predictable, and the turbulent regime when things go chaotic. And here what we see is volatility. In some ways, I like to describe it a bit like the speedometer of the markets. We're talking about, it gives us a sense of the risk. And so if you're running a car at 300 miles an hour and the speedometer says 80, and you had an accident, what would you feel? And the answer is obviously you'll feel the real speed you were running regardless of what the speedometer was saying. And that's a little bit what happens with volatility. You know, artificial low volatility or implied and realized can give you a sense. But when things go up, volatility explodes, you start to see this forced liquidation, correlations increase, liquidity thins up, and it creates a very mechanical process that forces liquidation that leads to this very nasty sell-offs, as we've seen multiple times. So this relationship bubble anti-bubble is pretty clear. It reinforces itself, but be careful because it also has the other side of the equation. You could see volatility going super low and that dragging in risk through risk parity or trend following or vol targeting or others. Now, I want to basically give also a little bit of application to these ideas. I'm well known for using the football analogy of a portfolio. I like people to think of the team where you're the coach, and at the end of the day, you make your allocation, you decide the players, you roll them out, but this is a game, it's a team effort where not every piece needs to do the same job. You want to achieve capital preservation and compounding. And this graph gives you an example of a key risk, what I call false diversification. In blue, you see the strategy that I manage. It did particularly well as a goalkeeper of the team during the crisis. It's been a much more difficult period, but as a team, things work well and you get also the benefit of compounding. So being a contrarian, being able to keep a balanced position and your team makes sense, whether it's in football or markets. Now, how does that look like? And generally, you know, if you want strikers, you would say, you know, I want equity, you know, public or private, I want credit. If you want midfielders, maybe you want real assets, you want cash. Although cash, in my opinion, is more of a striker in the bench, rather, you know, money sitting on the sidelines waiting to be invested. And then you have defenders. But I do think you need to build a portfolio with this profile of strikers, defenders, midfielders. Chris Cole, my dear guys, we call about the dragon portfolio, or this idea of having things that work well. But it's not just about the risk on, risk off, and volatility. It's also about inflation. And when you factor in inflation, you need to understand that the people that are going to pay the party here are clearly cash, credit, and fixed income. If you bought a bond where you pay $100 for something that will give you back 101 in 25 or 30 years, those $100, $101 are going to buy you absolutely nothing. Okay, that's my view. So all those fixed income assets, this cash, are short inflation, and I think the real inflation is way bigger than we discussed. So I would much rather favor a portfolio where the strikers are equities, where the midfielders are real assets, such as especially income assets such as real estate, and where the anti-bubbles, you know, things like gold or volatility are playing on the goalkeeper side. This is not something that you do by label, you do it by behavior. So in order to determine the behavior, you know, you need to look at how things work. We use precious metals, treasuries, volatility. We only buy options. We have an approach that gives us this very strong defender profile, and that works very well as a team with strikers to create more balanced portfolios. But I'd like to finish perhaps with one, before we open up for questions, with some examples. Everybody keeps asking me about options and how to implement them. And I think the topic that has become very relevant is carry and how we manage that. And to illustrate the point, I look at the VIX. The VIX, everybody follows the VIX, everybody knows it. Well, guess what? The VIX is not investable. So when you buy the ETF, you're really buying futures that roll. And guess what? In the last 3 years, since we launched Igneo, you would have seen that whilst the VIX is up almost 44%, people would have lost 80% of their value. So a dramatic divergence in the index and the actual investable, which comes largely from negative carry. This negative carry, you know, is the result of periods of extended contango and risk premia that people willing to pay for that insurance are having to pay as carry, and it's been as negative and painful as 10% per month, 10% per month. So you could lose 120% theoretically every year, which is why things explode. If you think about the volatility surface and the skew, which is how the market gives premium to different risks, you could see here that the market actually pays a ginormous premium for what we call low delta options, the probability of very large events. And this is something that we like to monetize. So we favor call spreads, which monetize that versus just plain vanilla calls. Other ways to look at things, whether it's gold or others, is to monetize that skew also with structures that are a little bit more interesting, where you give back some of your gains during benign scenarios. And you could do this, in both forms. We play, same things with the S&P on the downside. And the other part that is interesting, and I'll finish shortly, is the term structure of interest rates. Obviously, they carry from a market that is expecting interest rates to go up a lot, but fails to do that. And what you see here is what we call, forward starting interest rates, and how the market expects in 5 years' time that interest rates will be roughly about 175 across the entire curve. And so this term structures, the carry, the currencies, etc., are all very attractive and basically can help you. For those of you who are interested in perhaps learning more about the strategies that we manage and the client base and other aspects of the strategy, I'll be happy to, if you reach me out through LinkedIn or the email, that'll be an absolute pleasure. But we covered a lot of ground. I am sorry, Ryan, we may not have much time for questions, but I'm sure there are many, and those I cannot answer. I endeavor to do that in writing after this.
Thanks, Diego. That was super interesting, and I think we'll 15 minutes on questions. We're going a little bit later than we originally expected, but we'll send the recording around for anybody else who can't stay now. Just to introduce Glenda Levin. Glenda's our head of customer success at Allocator, and Glenda's going to go through the Q&A and just pick up on some things to ask you, Diego.
Thanks, Diego. Thanks so much. You glossed over gold I felt you glossed over gold because you talked about crypto, and I'm sure very many people on the call were interested in crypto, but someone has asked the question about what is your price of gold? Do you have an upper and lower boundary in terms of that? And where is that in relation to your gold price today in terms of the value today?
So I've held the view for a while that with the current, our models are pointing for much higher, but I would say two things. The first one is gold is very asymmetric. So we see thousands of upside versus hundreds of dollars of downside. So it's an asymmetric payout. But if you put a gun in my head, my view is we'll see $3,000 to $5,000 in the next 3 to 5 years, which is roughly 2 to 3 times where we're now.
And would you express that in the physical or the equities, or how would you express that?
That's expressed in the physical. The equities are a very good way to play gold as well, and they're great managers that specialize on that. They are similar plays, but they have a lot of basis risk. The biggest consideration, just lessons learned from other markets such as oil, is if you try to play oil through oil equities, everybody knows they're different. Yeah, BP versus oil, and this is multiple reasons, including taxes and expropriation, nationalization, and other things. But look, I think gold equities offer great value, just like gold, and I think there are great friends and managers such as the Jupiter guys that do an incredible job analyzing the company. So I recommend that if people want to play that, they the active management can actually make a difference, just like in the option space where we operate.
Okay, that's really very good, very interesting, actually. Maybe I can just quickly ask Ryan, how can Allocator be helpful to investors who are looking for alternative source of return? Just if you can just give us an idea.
Well, clearly the investor community, the universe of investment solutions is very heavily dominated by strikers. So pretty much most of the long-only funds in equity or credit or whatever, they do very well when the market does well. And this idea, this slide that I showed earlier with the risk of false diversification, right? I have a little bit of Apple, I have a little bit of Argentina, I have a little bit of oil, and it looks like you're diversified until boom, and a big event happens and the correlations go to +1, volatilities explode, and turns out that your risk was much greater. So I think your tool could help people stress scenarios under volatility and correlation scenarios that are in that bottom 10, what we call hostile markets. So to be honest, average correlations are meaningless. Okay, on a day-to-day basis, average correlations don't matter. What really matters is when you go into the hostile market, when things go really wrong. And here, it's really a very mechanical process, okay? It's very simple. When you see a big event happening in the markets, as a good friend of mine, an ex-Goldman colleague would say, when the market has a shock, it shows the position of the market. So if there was a shock right now, a war or whatever, God forbid, the markets that are long will go down generally, and the markets that are short will go up, because this burst of volatility creates a wave of risk reduction, and very often you see these things happen. So I think there's plenty of added value from platforms like yours on the risk management side that go well and beyond the day-to-day volatility and correlation, because what you really want is you want things to show you any hidden leverage, any correlation risk, anything that the eye cannot see, but this is what will make you bankrupt. And in that sense, what we're trying to do humbly with strategies like Igneo or other defenders and goalkeepers, you might look, a bit stupid at times when the market's going up, you might be losing money, but guess what? Just like a football team, you don't want to play with 11 strikers or 11 goalkeepers. I think you need the right team to be balanced, and you want to embrace that volatility. So I think understanding risk and understanding that the value of active managers in this process can also be very meaningful. And that's why I think when you come down to bringing strikers and goalkeepers to the field and helping people understand how the portfolios would behave under these extreme scenarios, which even if they look unlikely, they do happen, and you want to avoid a situation where you're taken out by the market. You want to take advantage of those opportunities through rebalancing, etc. So I think your platform certainly can help investors in that front.
Do you want to add something?
I think what I was thinking when you were going through your slides, talking about asset price appreciation, one of the things that we built out in the last few months is the ability to look at any return stream or asset return, or whether it's a portfolio or a fund, and to be able to look at it in, what does it look like in alternative currencies, or, what does it look like in Bitcoin or gold? And it's, it's super interesting just if, as a thought experiment, what are you measuring returns in? We've done some work on
the currency matters, of course, and that's very important. People sometimes, if you're investing in China, for example, be careful, because you might be the Chinese yuan. It's attracting a lot of interest because the government bond is paying 3%. So I rather earn 3% than 0%, right? And if the currency has zero risk, in fact, is going to appreciate, then free money, right? I earn my 3% on the currency and my currency appreciates. Guess what? When you have a big event, a big volatility, a big crisis, the market tends to unwind these things very, very aggressively. So I think the currency aspect, you need to think about investments in total return gain. I mean, those who lived Brexit understand perfectly how, as the pound was collapsing, real estate was going up, because in some ways, it matters for foreign investors is a total return gain. You think about it in your own currency. So currencies are important, but I do think stress testing portfolios through scenarios like Q4 2018 or even March 2020 is something that will happen again. I think it'd be very naive to think that this is it, and central banks are control and we're going to continue to cruise our way. Things will happen, events will happen, and you want to make sure that your portfolio is built in a way that you not only survive, but you also take advantage of these things. And to do that, I think you need the right team with the right players.
So I'm going to put you on the spot, Diego. What happens if you retiring and you can live for a long time, and we've got these huge bubbles at the moment across asset classes? Where'd you put your money?
Well, I speak by, I put my money where my mouth is. And look, I have a combination of equity, real estate, and gold and gold keepers. And I think you need a little bit of that. I think on the equity side, pick your choice. I mean, you could be an owner of your own company. You could buy Apple or whatever you want. That should be a percentage of the company. Just pick wisely. I think real estate is actually a very interesting place to be, because even if prices might look expensive in fixed dollars, with inflation on the rise, with the inability for central banks to hike interest rates, what do? I mean, you can actually, here in Spain, and I assume it's similar across Europe, you know, you can get a 30-year mortgage at 75 basis points fixed. This is it. No, so inflation doesn't need to be that high before you're already collecting money. So I think the real estate is obviously, you need to mind the leverage and be able to service the debt, and always these things happen at the wrong time. But I do have, and I think people should also have goalkeepers and defenders. Pick your choice. That are not so many, but certainly a good choice. And even within them, you should have a good diversification. We happen to be one of the best performers in the crisis in 2020. We've been suffering more in a year like this, and there's other great assets, you know, whether it's gold or volatility or others that, you know, I think could help in that process. But I used to play a lot of football. 20 kilos ago, I was okay. And I think the goalkeeper is always a very underrated position, both in football and in the portfolios. And so I think people should, they're probably well served on the goalkeepers, probably well served on the real estate. Generally speaking, I think they're going to be lighter in defenders. And for the time being, it doesn't look like you need them, but trust me, there'll be a time when these things come, and hopefully people are ready and not over levered, because it could be wild.
Okay, I'm going to ask you a very quick question for a one sentence answer, because I've got to hand it over to Ryan to call it a day today. It wouldn't be nice if I didn't ask you something on renewables. We didn't really talk about that. Could you just give us a one-liner on your views on renewables versus obviously the incumbents as it is today? Or maybe not, just renewables. I don't mind.
Oh, look, I think in the book, I talked about renewables and the flattening of the energy world. And I believe renewables are here to stay. And, you know, I have solar panels in my house, or I have electric car. The new frontier is batteries. I think in a world where you are producing excess solar and wind, perhaps when you don't need it, and this is creating volatility of supply, which is something you can't afford in the electricity market. I think the next frontier is the ability to store that energy and flatten. So I am actually putting a battery in my home as we speak. So, you know, you use those peaks that we get in Spain, maybe not so much in London, but I think the renewables is part of the energy mix. And I think batteries, as I mentioned, it's a very natural frontier as we continue to develop this. But the future for the energy markets, I think it's bright, in the sense that we can have a diverse source of cleaner, abundant, reliable fuels, which was the message that we were calling. And the dependence on oil, I think it's less than it was in many ways. And I think that silo has been broken, and that puts limits to the control of OPEC and also how far they can go before prices actually give in. So I think the long-term energy prices are likely to be more stable. And as of investments in equity or other aspects of renewables, I wouldn't comment because I don't follow them closely. But certainly, I do believe in the underlying, and that may or may not be a good investment. That's a different story. But the underlying is here to stay, and it's a positive for the energy markets.
Thanks so much. I'm going to hand over to Ryan.
Yeah, I think, Diego, I just want to really thank you for your time and for doing this. Super interesting. I think what we'll do is just ask you to give us a few links that we can send out. You mentioned a few of your articles and papers and the books. We can send out some links for reading afterwards. We'll get the recording out. There were a lot more questions that we didn't get to, so we'll send those your way, Diego, and it'd be great if we could get some answers out. The other thing I just mentioned is we do have quite a full schedule of webinars. I think we're booked now until the end of the year. So we'll be publishing the roadmap for that, the calendar, and we're looking at our 2022 calendar. But this is just something really nice. I've really enjoyed this. I hope everybody did as well. It's something we like to do for the community, and super interesting. So thanks so much, Diego, for doing this, and thanks everybody for attending. We had a fantastic audience.
So my pleasure. Thank you so much,
guys. Thank you so much.
Much health to all. Take care. Thank you. Bye.
Thank you.
Take care. Bye-bye.